Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage with our A&D Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. I hope everyone had a nice long weekend and is now ready to get a piece of fresh news from Billy and myself. Last Thursday, mortgages tightened quickly past CPI print and came back down to earth in the afternoon, still finishing ahead of the treasuries. The CPI data for December showed month-over-month inflation falling to negative 0.1%, with the yearly number at 6.5% inflation versus 7.1% in the prior months. Although CPI print fell right in the line with expectations, sectors like shelter and food continued to be in a headwind to declining inflation. The fight against inflation is certainly not over with the continued consumer demand and a strong labor market. We see market is steering towards 25 basis point hike in the next meeting at this moment. As for non-QM market updates, we have seen spread tightening as well, and we foresee this would improve non-QM rates by 25 to 50 basis points in the coming couple of weeks. I want to remind brokers we have a flow down options for loans locked at the higher rates. Please refer to lock policy on A&D website and reach out to lock desk for lock changes. At this moment, turning this to Billy to get more insight on the recent economic numbers and what indicators to watch ahead of the FOMC meeting on the February 1st. Hello Billy, how are you?
All's good, Alex. Alex, the last time we sat down to do a digest was on December 19th. Barely a week after the rallies from October had ended and the treasuries had posted their lowest yields in more than 3 months. Since then, we've seen 2 CPI reports, BLS report, final GDP, and of course a lot of lesser important numbers. And what we've learned is that inflation has continued to ease, while by most measures the economy remains in good shape and the labor markets are shockingly strong. The week before last, we learned that non-farm payrolls, which were expected to rise by 200,000, were actually up by 223,000. And then, as you addressed, the last week's CPI report showed CPI to be at 6.5%, down for the 6th consecutive month, which has not happened in at least 20 years, which is where the data I was looking at ended. And the month-over-month CPI was negative, and that was the first time that happened since January 2020. As you did mention, service and shelter CPI remains stubbornly high, but as good as the CPI numbers looked, they were exactly as expected. And yet yields dropped by double digits that day, indication the markets wanted to rally. Between the last digest and the last day of last year, yields went nowhere but up until the 5 and the 10-year had both given back half of their 100 basis point gains from October. So far this year, they've really gone nowhere but down, despite the bearish surprise on jobs and really no surprises at all that were bullish. Following last week's CPI report, the 5-year traded through its December yield trough by about 3 basis points, while the 10-year rally stalled about 3 basis points shy of the December yield trough. I had thought that the October yield crest represented the ends of what I would call third waves of still developing 5-wave impulses from 2020, and that the recovery should last 3 to 5 months. While that could still be the case, I think it has become nearly as likely that the October yield crest will represent the ends of the entire impulses from 2020, in which case corrective recoveries could last well into next year. Fed continues to talk hawkish, but with CPI now at 6.5%, down from 9.1 in July, it's more than a third of the way back to the Fed's 2% target. And my guess is that the Fed will likely pause with Fed funds at 5, maybe 5.25%, and see what happens from there. I wouldn't be looking for a pivot anytime soon, but a pause seems likely. And if the longer maturities can follow the 5-year through the December yield troughs, I think we could be in for a really good year. And I want to remind you all that we're to tune in to our roundtable discussion on the real estate and mortgage markets for 2023. That will be on the 24th of the month, and you can find a link to it on our website. Alex, kick it back to you.
Billy, thank you so much for the overview. We're all excited to see 25 basis points hike on the next FOMC meeting for sure. I'm looking forward to our webinar next week on January 24th. Everyone, be sure to join that one. It's an experts roundtable on the non-QM with Billy, myself, Max and Rob Chrisman. It is January 24th at 1 p.m. Make sure to follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital market events. Thanks everyone. It was Alex Suslov, Head of Capital Markets at A&D Mortgage. Stay tuned.